So let's take a look at an example of a bond issued at premium. In early December 2020, a corporation has prepared a $100,000 bond with a stated interest rate of 9% per annum, per year. This bond is dated as of January 1, 2021 and has a maturity date of December 31, 2025. The bond's interest payment is paid once a year. This means that the corporation will be required to make annual interest payments of $9,000, which is calculated as $100,000 multiplied by 9%. Now, here's what we assume. We assume that this bond is issued in an 8% market rate and therefore will be sold at premium, which is $104,100. So here's what's going to happen. On the very first day of the issuance, January 1st, 2021. So on the date of the issuance, we are going to record cash. Because we're issuing this bond in exchange for this cash. So $104,100. We're going to enter bonds payable because we bear the liability to pay back this bond's value, and that is 100,000 because that's the original value of our bonds payable. And we are also going to record premium on bonds payable, and that's going to be the difference between cash and the bonds payable, which is $4,100. That's the first day of this is the issuance accounting journalization. Now, if we use a straight line amortization of bond premium of this 4,100, this is basically, as the name suggests, we just divide it into equal parts, which is 5 years. So we divide 4,100 by 5, and that gives us 820. Amortization straight line, meaning that each year we're going to amortize exactly the same value, and we're going to record that. So at the end of the first year, December 31 December 2021, we are going to record the payment of interest, and that is involving obviously cash payment of 9,000, and that we already know. We're going to pay $9,000 of cash, which is our interest payment. We are going to also amortize our bond premium, which we already know. Premium on bond payable is already calculated as 820. We're going to amortize that amount, and our interest expense is going to be the difference between 9,000 and 820, and that gives us 8,180. So if you sum these two together, that gives us 9,000. But don't forget that despite the fact that we have issued our bond at premium, we are paying the interest based on those 100, not 104,100. We're paying it on basis of this stated value of our bond, and that is 9,000. And when we amortize our bond payable, a premium on bond payable, we get interest expense of 8,180. Now, if we'll take a look, let me just break it down. So if we take a look, and obviously, so we're going to have a similar entry at December 31, 2022, 2023, 24, and 25 until the end. And this is basically the snippet of what it's going to look like for our premium on bond payable. Since we've already recorded, so if we take a look up here, this is going to be journalization, not journal, but the ledger for premium on bond payable, and the very first entry we made was 4,100 when we issued the bond at issuance. Let me just write it. At issuance we recorded this. Let me just let's just go like this, yeah, at issuance. Later we amortized 820 on 31st December 2021. Later we again we will amortize 800 and, sorry, the same day but the next year. Again 820, sorry, 820, and again 820, and lastly in 2000. Yeah, these are the dates of the payment and the amortization. Yeah, December 31, 2024, and finally December 2025. So once we amortize all of these are the dates of those entries. This is at issuance, which is January, yeah, January 1. January 1, 2021 at issuance, and finally the balance at the end as a balance on December 31. Let me just write it separately so the format will come out correct. December 2021 is going to be this, and yeah, so what happens is that by the end, by the maturity date, the premium on bond payable will be amortized and be equal to 0. So here, if you ask why do we need to amortize and bring our premium on bonds payable to 0, the explanation I hope to give you using this table. Yeah, so let me just select appropriate number of columns and rows. So what do we have here? Yeah, the date, the credit in bonds, yeah, credit balance in bonds payable account. That's going to be, let me just bring it down so that it looks neat. And while I'm trying to build, let me just maybe move this table a little bit so that it doesn't mess with my other tables. Yeah, and bring it down to this side. Let me just use this. Here's what we have. Yeah, we have this table, and using this table I hope to bring the light into what's happening in here. Here, let's see, credit and balance, and then we have credit balance in bonds, sorry, in bond, just let it be premium premium on bonds payable account. Yeah, also let me bring it down to appropriate size, which I'm kind of not liking that much, but let's just do this way. Yeah, and finally we will have a book value of the bonds. Yeah, so let me use this to bring some light into this. So on January 1, 2021, we have issued our bonds at $100,000. Yeah, we credited, so the stated value, I'm sorry, was 100,000, but we issued it at 104,100, which means that we had 4,100 as our premium. Yeah, and this is the account that we have credited. If you remember, if we can actually go back and check it. Yep, here it is. We credited bonds payable 100,000, premium on bonds payable 4,100. Now, again, the book value of the bonds at that moment was 104,100. Yeah, correct me if I'm wrong, but I think that's correct. Yeah. Next, on December 31, let me just write it. December, just a second. December 2021, the same year when we paid our first interest payment. Our so the value of our bonds don't change. They're still at 100. Yeah, let me just write the $100 to it. But the credit balance and premium on bonds payable changes because we have at first credited, yeah, this credited, and then we debited 820. So if I have to use formula, if I can, let me just see it, minus this 820, it's going to give me the balance of 280. So the book value will change as well. Yeah, so the book value will change. Just a second. The book value will change to also this, which will bring us to 103,280. Yeah, how do we calculate that? Is the book value of the bonds minus the amortized value on premium on bonds payable, and that brings us at the end of the first year to a new book value of our bonds to 103,000. And similarly, we were going to do the same kind of entry for so 2022. We still have the same value on our bonds, so until the end we have the same value of our bonds until the end, but the credit balance or the balance on our bonds, premium on bonds, will change, because now 3,280 minus the next year payment, which is this one, 820, will bring us to the lower value. And again, I can do this here the same way, so the book value will change to 102,460. And again, we're going to do the 2,480 minus this 820 the next year we paid. And again, I can drag the formula, same calculation, so 102,000, so the book value of the previous year minus the amortized premium that we are sort of recording next year or this year. It's going to bring us to the 101. And finally, sorry, I can just drag the formula. 1,640, which was the balance at this point. I can actually do that calculation here as well. I just don't want to confuse you, so the only way I can do this is, for example, do this and change this as like bold, meaning that this is balance. Yeah, it doesn't mean the entry, it just shows the balance at specific point. But I just don't want to confuse you, so let's forget about it. Anyhow, so and the date here is December 23. 31 December 24, and this is the 31st December of 25th, the final year of our payment, and the maturity date, I'm sorry. And then finally, the last year, also the balance, once we enter final 820, we're coming back to premium balance of this 0. Yeah, as you can see, the balance will be 0, just like there it is. And then once we drag the formula, it's also going to give us the book value of the bonds at the end of the 5th year as 100,000. Yeah, so this is why we need to amortize our premium on bonds payable, because at the issuance, at the date of the issue, the value is much higher, or a little bit higher. We sold it at premium, but the value of our bonds is still the same. So we need to amortize the premium on bonds payable until the maturity date, which will bring us again back to the book value of the bonds of 100,000, which we will have to, as an issuing company, we will pay back to our bond holders. I hope that was useful.